In sailing, a slack tide is that brief moment when waters are completely still before the current changes direction. Today's markets might be experiencing their own slack tide, caught between strong fourth quarter growth and the potential headwinds of Trump's policies. So while investors do remain optimistic, tariffs, immigration restrictions, and spending cuts could be about to change the economic current. So why might the market be underestimating these risks? We're going to get into that and a whole lot more right now on UBS Trending. Hi, everyone, and thank you for joining us. My name is Anthony Pastore. I'm the host of UBS Trending. Thanks for being here. Connor Fitzgerald, he's the fixed income portfolio manager from Hartford Funds, is here in the studio with me today. Connor, nice to have you.
Thanks for having me back.
Good to have you back. I think I can't even remember exactly when you were here the last time, but things were very different. And I kind of referenced a recent white paper that you wrote called "Sitting in the Slack Tide of U.S. Fiscal Stimulus." And so we're going to get into that and more. But I wanted to start with the idea that the markets do seem pretty optimistic, whether you're looking at equities or treasuries. There's a lot of optimism out there, but also still a lot of uncertainty that we're talking about. Why do you think that that is the case right now?
So I think the market's optimistic because I think the baseline level of growth, which you referenced a few minutes ago, still pretty strong. Still think household balance sheets really strong, corporate sector balance sheets really strong. And we came into this year, I think, with a lot of excitement about that cycle being able to continue because of positive animal spirits, because of things like deregulation, and just this general idea that Trump is pro-business, pro the stock market, and that we could run a little bit further with that. So I think you summarize it well. We're a little bit of a push-pull with the economy's doing fine as it stands today, but now we're really grappling with, some policies that may or may not be enacted. And I think there's also this idea that these are negotiating tactics, which he's alluded to in the past. So it's hard to really speculate on what could come to pass until we actually see what's implemented. But for now, I think the economy's arguably doing A-OK.
Yeah. I mean, going back to November of 2024, after the election results came through, the markets rallied on this pro-business stance that Trump took on the campaign trail. I think what's happening now, and of course, this is what you're writing about, is the uncertainty of tariffs and spending cuts and immigration. I think everybody is sort of messing with investors' minds. So if you look at the potential negative side of things, what areas of the market that you're tracking could really be affected by that?
So I think the way we've tried to lay it out is that I think coming into this year, the market was more focused on tax cuts and pro-growth policies.
Right.
But what we've seen them move faster on are things like the Department of Government Efficiency, I think, has moved far more aggressive than we would have expected. Immigration, I think in hindsight seems obvious, but they've moved very aggressively on that. I think immigration is a very strong positive force for an economy. I think lower immigration, less growth, more so than important on the inflation side. So in terms of sectors, I don't have one specific sector that I would necessarily call out. I think it's really just the general economy. And I would specifically point to the amount of hiring that we've had in government sectors and healthcare sectors, where I think going back 3 years, it's about 43% of hiring. So any sectors or companies that are exposed to federal government contracts, I think are pretty much under scrutiny. And I think in general, the rest of the labor market is okay and sort of in balance. There's not a lot of hiring, there's not a lot of firing. But if the main job growth engine is now going the other way, I think you could move the unemployment rate up pretty quickly. And I think that's something the Fed would pay attention to. So that's really the number one thing that we're focused on, is just slower growth and slower hiring.
Yeah, and I'm glad you brought up the Fed. I mean, with the recent statement that came out where they did keep rates unchanged as expected, they did say in that statement that there's some uncertainty on the economy. Obviously, what you just rattled off there certainly is a big part of, I'm sure, what those conversations were in that room with the FOMC members. On the flip side, obviously, there are some really positive areas in the fixed income markets here at UBS. We're still saying you got to put that cash to work. Don't sit on the sidelines, even in volatility. And we kind of like that 5 to 7 year part of the curve. What are you thinking about where the opportunities are, whether it's the yield curve or a particular asset class?
Very much in agreement with that. I think intermediate treasuries we would describe as a good place to anchor portfolios. We still think credit fundamentals are strong, but given how compressed valuations are, I wouldn't necessarily recommend a huge allocation to high yield. Focus more on investment grade, where I think you can get a pretty reasonable spread still, especially relative to history and relative to other parts of the curve. And I do think, to go back to this idea of like the policies that they're trying to enact, if you just look at the impact on growth from spending from the federal government, I think we can all agree it's been significant over the past few years. If that's reversing, I think we might, after re-rating trend growth and neutral rates or terminal rates higher in the fourth quarter last year, we might have to move that back maybe to closer to where they were in the middle of last year, which I think gives the Fed, potentially room when they get some data in hand to maybe tweak policy rates a little bit lower. And I think that intermediate part of the curve will probably be the largest beneficiary of that move if neutral and terminal rates move a little bit lower versus expectations.
Right. Yeah, and the expectation for us here at CIO at UBS is still a 50 basis point cut this year from the Fed. Obviously, with the Fed saying what they said in the recent statement, it seems like they know what direction they need to go in, but there's a possibility that they could kind of stall out, which we were talking a little earlier. That could certainly impact Treasuries, especially yields. We could see another inversion of the yield curve, which I think a lot of people equate that to, now we're in for a recession. I don't know if that's something that you're tracking.
Yeah, I think it will depend on how much the Fed wants to lean against the inflationary side of the impact from tariffs.
Right.
And I think yesterday they were more clear than I would have expected that they think it's a short-term factor. And they at no point referenced potentially tweaking policy higher. It was more like stay the same or potentially move rates lower. So I think that kind of shows where the skew of outcomes is in their mind at least.
Right. And we were saying also like the Fed, there's a lot of smart people in that room who understand markets and what could potentially happen if they decide to sort of really shift, either stay the same or, I don't think this is in the cards, but raise rates. That would just, be something I don't think we would expect. I want to go back to what you were writing about in this recent note about the slack tide, because you sort of do these outcome A and outcome B, sure. And outcome B is more about like the sort of unexpected and how do you plan for that. And when you think about uncertainty, do you have an outlook for whether it's the medium to long term?
So I think coming into this year, I was very constructive on the U.S. economy, and I'd say I've grown less constructive because I do think Trump 2.0 administration is very committed to what they feel like they got elected to do in terms of the mandate. And I can't tell you the last time I heard a politician say a phrase akin to no pain, no gain. I think typically politicians are more focused on the short term. They seem to have a long-term plan, and that long-term plan I think does necessitate, lowering spending at the federal government level. And I think we all can agree that deficits are kind of at levels where, maybe they're sustainable for a period of time here, but ultimately they need to fix that. I think that's a huge focus of Treasury Secretary Scott Bessent, but they need to find a way to like thread the needle where they can't pull back spending that's buoying the economy so fast that we go into recession, because then the deficit will explode because the revenue side of the equation collapses. But I do think we've kind of, that was sort of the point of the slack tide analogy. We've kind of reached like the upper bounds of what we can do in fiscal, which makes me think it can only go one way. And I do think that like if there's one thing I had to point to why 2022 wasn't a recession the way many folks expected, it's because there was a 7 to 8% budget deficit running in the background. We've never really experienced that in non-crisis, non-wartime period, and that really supported the economy. So if we're going to take that back, all else equal, I think growth has to slow. So I think that's what the market has started to engage with, but now I think there's a lot of debates of like, well, how much can it slow? And that's usually how things go when you start pushing towards lower growth. But I think to me, that's the challenge that market participants face. So I'd say I'm a little bit less constructive short term. I think some of the policies they're pursuing are actually quite positive long term in terms of less government spending, more private sector. I think there's good data to support that, but there's going to be a transitional period with a lot of volatility. I think that's our core view.
Yeah, for sure, especially the short-term pains, as you were talking about, no pain, no gain. And given the fact that there is a lot of uncertainty, of course, one of the things we subscribe to is long-term investing and obviously having a very well-diversified portfolio. So given that, I think one of the most important things that I want to talk about with you is this kind of idea of making sure that active management is really sort of playing a role, because especially with the uncertainty that we're seeing. Just talk about your approach to active management.
I think our approach to active management really centers on this idea that the world's always changing.
Right.
And we had a couple charts up here, but like even just the interpretation of Trump going into the election vis-a-vis what people think now has done a full 180, and we've unwound all those, Republican sweep basket trades. I would even point to, certainly not an AI expert, but like what happened with DeepSeek and how quickly that upset the AI theme. So I just think we're in a period where, whether it was regime change from no longer having central banks buying bonds, and now you have a very pro-US inward focused administration who's trying to tackle the deficit and is even talking about where 10-year treasury yields are. I mean, these are things that certainly have never been talked about in my career. So I just think that we're going to have a period of a lot of volatility. I think there's a lot of room for people who are willing to think creatively about how things can unfold in the future. I think there's a lot of value to be subscribed to that type of thinking. So I think it's just, there's going to be a lot of change in the next couple of years. The status quo likely won't persist along many dimensions, and I think there's a lot of room for active management to succeed. And there's going to be a lot of volatility, and so that volatility can create opportunity the same way it can create risks. So that's sort of what we're excited about. I mean, we get excited to go to work and try to figure these things out, and that's what we've been doing the last couple weeks.
Yeah, good stuff. Obviously, you have to. I mean, it's been certainly a bit of a roller coaster, but thanks for doing what you do. Connor, thanks for joining me. Good conversation. Appreciate you.
Thanks a lot.
Thank you,
Really
Connor Fitzgerald from Hartford Funds. And for more information on everything that Connor and I talked about, you can check out our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the major channels, LinkedIn, Facebook, as well as Instagram. Right there on your screen. Check us out at UBS Trending on Instagram. And as always, if you have any questions about what we spoke about today, make sure you're continuing this conversation with a financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.